They tended to rely on historically recorded amounts, and you would only adjust those historical amounts to the extent that an actual transaction was realized to record the gain or loss. Over the course of time, the environment has been such that certain economic events have happened, and the reality that historical cost of instruments and transactions might differ a lot from what the fair value or the settlement would be. So the FASB has been rolling out various standards to essentially bring estimates into play and to try to add those judgments to record financial statements closer to what the expected settlement value would be, hypothetically, if it were to happen today, even if those gains and losses might not be realized in the future. So I know that's a really broad brush to paint with here, but CECL is really trying to take some of those fair value concepts that have been applied to investments, revenue recognition, leases, things like that, and put those in some of these financial instruments which previously had not been adjusted for fair values. So with that being said, the objective is to recognize on day one the expected gains or losses that might be recognized in related to a financial instrument when it's recorded at inception. Historically, a lot of receivables, loans, and things might have some broad reserve against them, but it was really only contemplating information known at that time. CECL is expecting companies to predict the future a little bit and to consider economic factors and a lot of other things that we'll cover today. So all of that is going to lead us to include more estimates in the financial statements, disclosures around that, and that's sort of what we're going to be talking about today. So if we move on to the next slide here. Okay, so started really big picture, but can we go back? There we go. So we wanted to create at a high level what CECL is doing versus legacy GAAP. So CECL stands for the current expected loss model. As I mentioned, we're looking at assets and we're trying to estimate what is the lifetime of potential losses and recording those on day one. So it's required to be done regardless of the remoteness of those losses or gains. And you're supposed to consider current economic factors as well as forecasted information. So as I mentioned, this is a little bit more forward-looking than what was in the past. In contrast, legacy GAAP, there was this concept that you would only recognize losses if they met a probable threshold. So from the accounting standards, ASC 350, there's this concept of probable versus non-probable. So, like a 50% likelihood. The standard setters believe that likelihood has, this 50% threshold has made companies more reactive in recording financial information, and CECL's intending to be more proactive, to estimate the fact that, in the case of a simple trade receivable, a company would know that a portion of its receivables simply won't be collected. It might be a small portion, but the idea is that there should be some sort of more general reserve that's forward-looking, as opposed to just waiting until that loss is known. So that's sort of the framework here. And part of the reason for this standard is that there was a financial crisis in 2008, 2009. There's been a number of different ones that we've all experienced, right? But a lot of these losses were recognized much later, only when a crisis occurred. And the concept of CECL is to try to take into account some of those factors in advance, get those on the balance sheet and income statement. All right, so if we could use that to move to our next slide. So I'm going to talk a little bit about just the process for transitioning into this guidance. So again, we've got a lot of text here, but the process for implementing the standard, kind of like any new accounting standard, is that you've got to identify what is the impact of CECL. Once you apply this new model, these considerations that we're going to talk about a little bit later, if you applied those on the first day of the current fiscal year, what would that difference be from your historical model versus a CECL model? That the impact of that day one adjustment would be reflected in the financial statements. Typically, if that's going to be material, that's going to be an adjustment to opening net assets rather than going through the P&L. And then that same model would be applied again at the end of the year. So you would have sort of a comparative number there, but it wouldn't go through earnings. Now, it depends on the entity, because a lot of companies applying CECL, they might conclude it's not material enough to reflect an adjustment to opening net assets, which is okay, but there would be expected to be some disclosures surrounding that. And again, we'll talk about how CECL affects different entities in different ways, and whether or not there's expected to be an adjustment. I would say broadly, if your entity does a lot of lending, which a lot of not-for-profits do, the expectation is that CECL is going to drive those reserves up. Or to the extent that you have a business that has a lot of trade receivables or things like that, the expectation is that CECL would drive that reserve up, maybe not in a really material way, depending on how quickly your receivables turn. As Kendall's going to highlight a little later, there are some impacts to investment portfolios and things like that too. It depends on the nature of your investments. For instance, if you've got a lot of equity type investments that are marked to market already, CECL might not have that much of an impact. But if you do have some debt securities that are more of an amortized cost basis, CECL could have a decent sized impact to your organization. So we'll talk about that a little bit, but this is just sort of how it flows into the financial statements. With that, let's move to the next slide. All right, so we've got some definitions.
Justin, one thing I wanted to highlight on that last slide real quick was just, so when you're factoring in any opening net asset impact, you need to be cognizant of which bucket it goes into, whether it's donor restricted or unrestricted net assets. So what the ASCU 2016-14 and ASC 958 guidance basically states is that impact should follow the financial asset. So you need to kind of identify which bucket those financial assets normally fall under, and then adjust the donor restricted or the unrestricted accordingly.
Great point, Kendall. Thanks for pausing there. So yeah, I guess to connect that to what I was mentioning, to the extent that you have an endowment fund that is donor restricted, and there's a whole investment portfolio that has some debt securities that do require reserve adjustments, the expectation would be that those adjustments would go into the donor restricted net assets, which would differ. Obviously, a lot of not-for-profits don't have donor restrictions affecting their accounts, so it might be unrestricted. Okay, so we've got a definition here for credit losses. Pretty simple. It's credit loss. Credit losses it's a valuation account, right? You're estimating what those losses could be. It's going to be you're going to have your historical basis, amortized cost basis, and then you're going to have this valuation adjustment to try and true it up based on expected future results. They're typically presented net on the financial statements. Let's move to the next slide, please. Okay, so this is the process that an entity should go through to identify how the standard affects the financial statements, if at all, and walking it through to those final financial statements. So our presentation today is going to walk through these various stages. And I know that a lot of companies have concluded or maybe estimated that CECL is really not going to have a big effect on their financial statements, right? It might be that they don't have any loans, they don't have a lot of long-term receivables, or maybe none. We have some software clients. I know that there are even not-for-profit businesses that actually have software platforms where there might be customer prepayments, right? So there's not a lot of risk of collectability because there aren't really significant receivables. So in those situations, we would strongly recommend that a company still go through these steps, because they help to make sure that you're not missing any accounts that you wouldn't ordinarily think of, right? You might be thinking, I don't have a financial institution, so therefore CECL is not a big deal. But this first step is really critical, right? And we're going to go through this next, actually, where we just go through and look at, well, what are all the assets that could be subject to CECL? And a great practice is to document that and to just have, even if it's a brief memo, think about what could be subject to CECL in your organization, and then whether or not there would be an effect. Based on that, you might determine that you don't really have a whole lot of risk pools that need to be evaluated. And maybe your current estimates within financial instruments don't really need to change. If that's your case, that's great, right? That's easy. But getting that documented so that you can disclose it in your ending financial statements is a really good idea, just because things can change in operations, and it's good to have at least a benchmark at one point where you determine what the effect was. And then you can look back on that and say, oh, well, we did start this loan program, for instance, or we have some kind of large balance that changed, and maybe we do need to evaluate that for credit losses in the future. All right. That being said, I'm going to hand it over to Kendall to talk a little bit about what is within the scope of CECL.
So we're going to start talking about scope. So what is within the scope of CECL and what is scoped out? So similar to ASC 842, which all of you have recently gone through, one of the challenges with the standard is understanding completeness of your financial asset portfolio and understanding what exactly is scoped in. And then also by understanding what's scoped out, it helps you limit the amount of work, because you don't want to start going down a rabbit hole on a potential financial asset or certain account that maybe is not scoped in and didn't need to be evaluated, because you can scope it out. So the first one that we've talked a little bit about already is financial assets at amortized cost. So this is going to be the bulk of what's scoped in. That's going to be any notes receivable or loans, among other things. The next is some of the investments that are scoped in. So that is available for sale debt securities. And then also there's certain cash equivalents that are, CDs, money market, those kind of things that are actually scoped in. We'll go over that a little bit later as well. Net investments in leases. So this is on the lessor side. And one thing to note, sorry, you go back, Shelley, thank you. The receivables related to operating leases are scoped out. So this is only lessor, and this is direct financing or sales type leases that would be scoped in, and anything operating related. So if you have any lessor leases or any subleases, those would actually be scoped out if you are straight lining and you have a deferred rent receivable or any kind of rent receivable. Also, any off balance sheet credit exposure, that's probably not very common, but if anybody has that, as long as it's not accounted as insurance. And as far as other things that are scoped out, so the most relevant for the nonprofit group here is going to be contributions and pledges receivable, as well as research contributions. So those are not scoped into the standard. Lastly, one other thing before we get into the last item was loans receivable. So if those are under common controls, so related party loans, those are scoped out. And also any financial assets that are measured at fair value. So if you have any loans receivable and you take the fair value election and you're recording those at fair value, as Justin mentioned, the impact is going to be largely based on any amortized cost loans. So if you're recording something at fair value, the substance of the standard is really to try to align with fair value. As Justin mentioned, that's what the FASB was trying to do with this. So if it's already at fair value, there's really no point. So that's why that was scoped out as well. Next slide, please.
Yeah, I'll just say as a rule of thumb, if you could go back, Shelley, sorry. The FASB is using this as sort of a catch-all, but for more recent standards, the FASB had recently issued guidance around pledges receivable. So those have been covered. Same thing with the codification ASC 958 for not-for-profits. And as you probably are painfully aware, the leasing standard is pretty recent. So any recent standards have already factored these concepts of fair value and estimates in, and this is really just kind of catching everything else that slipped through the cracks.
Yep.
And just one thing to highlight for our nonprofit organizations, one of the big items is going back through and re-reviewing all of your government grants and remembering to take a look at whether or not from that clarification, if those government grants were deemed a contribution or the exchange transaction underneath the new revenue recognition model. So a lot of those government grants should have been deemed a contribution, which means those government receivables are going to be scoped out. But if they fall under the exchange transaction and the new revenue recognition model, they will be following under the CECL guidance. So like Justin said, a lot of that new guidance did come into play, but that was why there was that clarification. FASB was forward thinking on some of these items.
Yeah, great point. Okay, next slide. So here is a somewhat comprehensive list, but I don't think it includes everything of common assets that are within the scope of 326 or CECL. And to the right, you'll see kind of a summary of the overall impact to those accounts. So this is, obviously different for every organization, but this is in general, on an average, what is likely the impact. So you see cash and cash equivalents. So we mentioned CDs and money markets and things like that. The impact is likely low. There's usually pretty low losses on those. As far as accounts receivable, so net of the allowance, so this is replacing the allowance for doubtful account. That could be anywhere from low to medium to high, depending on the nature of those receivables, the length of time, and a number of qualitative factors. That really could vary. So I know it says medium to high, but it could also be low depending on the nature of those. Contract assets, so that's kind of what Shannon was mentioning at, right? So anything under ASC 606 or other income under ASC 610 that would result in a contract asset, that would be within the scope. That could be medium to high, depending on the nature of those and the potential time between when those are ultimately collected or not. Investments in held to maturity debt securities. So because this one and also the investments in available for sale, as well as the two down below, you'll see investments available for sale that are net of allowance, and as well as the non-credit impaired. So those impacts are fairly low. The ones that are going to have bigger impacts are some of these other ones, but depending on the nature of your portfolio, it could be a bigger impact. As far as off-balance sheet exposure, we talked briefly about that one. I'll skip over that since it's not as common. Net investments in leases, so that's again the lessor side of things for held to maturity. Sorry, the direct financing or the sales type leases, and then lastly accrued interest. So if you have any loans and you have accrued interest, that would also be scoped in. So you'll see the column to the left, these are the ones that are amortized cost instruments, and then in the middle there, available for sale debt securities, which are also scoped in. Next slide, please. So kind of expanding the definition of what amortized cost is. So that really is the cost basis of the financing receivable or investment. So that's the originated value or the original value acquired, and then it's adjusted for these bullets below. So any accrued interest, any accretion or amortization of a premium or discount, and then any deferred financing costs and a few other adjustments as well. So that's going to be what your amortized cost basis is. That's basically your starting point, and then you'll adjust for CECL from there. Our cash equivalents within the scope of ASC 326. So it depends is the answer. So the definition of a cash equivalent, I'm sure everybody's aware, but it's a highly liquid instrument with a maturity of 3 months or less. So there's certain things that are scoped within the standard. Those are generally money markets and CDs, but there might be a few other things within the scope, and those would fall within the 326 model. One thing to highlight here is any US government bonds, if they meet certain criteria, are allowed to have a zero, and the expectation is to have a zero CECL allowance. And we'll go over the specific requirements a little bit later in the training, but just note any US government bonds, because there's assumed that there's very little risk in that. So that's why that was written into the standard, that nil was okay. Not just one thing to highlight, or this is not intended to be US Treasury securities only. So there's other things in here that you need to be aware of. Next slide, please. All right, so one other thing to highlight is tax receivables. So if there's any tax refunds or other tax receivables, are those scoped into the standard? So generally the answer is no. So if you have your general tax refunds, those are generally scoped out. So that would be, for example, a refund resulting from overpayment of non-exempt federal taxes. So that would be scoped out of the standard, but certain things are scoped in. So an example is if you have a tax receivable contractually reduced through judgments from a litigation or contractual settlement. So, litigation contractual settlements, those types of things are a little different than your normal tax refund, and that would be scoped in.
And I would just point out on that one, if you could go back, sorry, Shelley. So while there might be certain situations where you do have a final judgment and you've got a receivable on your books for that, in this second example, in reality, if you have that final judgment from, say, a governmental authority, chances are you're probably going to have a pretty low reserve on it anyway, right? Like if you've got a statement saying that the federal government needs to pay you X dollars and a court's agreed on that, you probably aren't even going to have a reserve on it. So while in the scoping of ASC 326, you would need to evaluate it, it probably won't have a financial impact, but just wanted to highlight that nuance here.
Yep. Obviously, right, Justin, it probably depends on the jurisdiction, and the U.S. government probably a little more reliable than some foreign jurisdictions if it's in another country or something like that.
That's a good point. Some of these international matters where there's lots of upheaval in the government or the economy could have a different answer for sure.
Yep. So this is a example statement of financial position, and the exercise here is going to be trying to identify which assets are within the scope of CECL. So in the chat, if you want to make this interactive, we can just start putting any that you identify, and then I can kind of run through the results. Give everybody a couple minutes to read through the balance sheet. Okay, Shannon, accounts receivable. Yep, that is within the scope. There's a couple tricky ones in here that are actually scoped out, so just keep that in mind. Cash equivalents, yep. We talked about that earlier. All right. Let's skip forward, Shelley, and we can kind of go over the results. So I think we got a couple of them, right? Those are the a couple of the ones we've highlighted the most is AR and cash equivalents. So a couple to keep in mind too, right? CDs that we have below cash equivalents. I'm guessing those are longer term, so they're not 3 months or less, but they're still current. So they were a separate line item. So that would be under those short-term investments that were also within the scope. Accounts receivable and security deposits was the other one. Couple to highlight, right? So we talked about contributions receivable is scoped out. So that's called out here. But another one that we don't actually have on the slide that is scoped out is the right of use asset operating lease, right? So this is on the lessee side, right? So it's only lessor side and it's an operating lease. So that is also scoped out. To the right, go back real quick. So to the right, we do have an example disclosure. So the big takeaway, and I think Justin maybe briefly talked about this, was even if the standard doesn't affect you and you don't have an adjustment, there is going to be an impact to everybody, and that's going to be to update your disclosures. So there's going to be additional language or revised language about the allowance for credit loss. So it's not going to be allowance for doubtful anymore for your trade AR. And then also you're going to have potential expanded disclosures on other financial assets. We do have this allowance for doubtful disclosure in this example down below because the 2022 balance for comparative purposes was different. So that's why they left that in here. All right. I'll pass it back to Justin, who's going to talk about risk pools, which is step 2.
Kendall. Okay, so I guess at a real high level, as Kendall showed, you first have to figure out which accounts are in the scope of CECL and which are out, right? Once you do that, then we have to apply an approach to valuation reserves. So a company is required under ASC 326 to measure the expected credit losses on a collective basis or a pool. So I guess in layman's terms, what this means is you want to identify assets that have similar characteristics, and based on those characteristics, you can then calculate a reserve. So as is frequently the case, the guidance doesn't exactly tell you how to do this, but it would be probably inappropriate if you had loans receivable on your books to try and calculate a similar reserve as you might for a money market account, right? Like they would probably have different levels of risk, which might also be really different from a trade receivable. So the idea is that you want to try to identify homogeneous populations of financial instruments, pool them together, and then develop an appropriate methodology to determine what is truly the credit risk of loss, or the risk of credit loss associated with that pool. So, so we've got some factors here that you should consider. But yeah, I guess the overall message is that once you have some different pools, then you can identify the appropriate approach to set a reserve for each of them. And then so we've done this in practice. We help a lot of our clients with this, and it might be that certain financial statement lines just have a different model that makes sense for each financial statement line. But it could also be, let's say that you have a loan portfolio, that you have some higher risk loans in there and some lower risk loans. And it might be inappropriate to establish a reserve for high risk loans that's the same calculated amount as for a lower risk loan. So we're gonna go through some more practical examples here. But yeah, that's kind of the step. Once you figure out which assets are in scope, then sort of identifying which ones have similar fact patterns. All right, so with that, we'll move to the next slide. So some things that impact whether assets should or should not be pooled together are aging buckets, right? So this is more of a trade receivables example, but you might have certain receivables that are all current, and that might be a bulk of the population. And you might have some receivables that are very late, and in which case they might have different levels of risk associated with them. Now, I want to caveat that a little bit. I think that a lot of companies with trade receivables historically would only start setting reserves on the receivables once they made it into those 90-day buckets, right? And they'd say, okay, with the hindsight, we now know that these receivables are riskier, therefore we're going to create an allowance only for those. The approach of CECL is trying to encourage would be a little bit more forward-looking than that. Maybe not just assuming that you have a zero reserve for anything that's current or in a 30-day window, because you do know that all those 90-day reserves that are uncollectible, we know that those ones were current at one point in time, right? So the concept behind CECL is trying to set at least some type of minimum reserve, predicting that some of these are likely to be less collectible. So there might be other ways to identify similar risks in a trade receivable. It might be that certain customers have great credit history, and that you can create pools within trade receivables reflective of what is the credit risk of particular customers. Now, again, we're talking about how this applies to not-for-profit entities. So trade receivables might not be as applicable to your entity, but I just wanted to highlight that a little bit because that is a shift going from that only using hindsight of what is past due to trying to make it more forward-looking. So there is a little bit of room for creativity here and entity-specific considerations. All right, now as we're talking about loans, things like that, collateral is a big factor, right? If you have loans receivable that are completely covered by collateral, that might be something that really reduces the risk from non-collateralized loans or receivables. So that should be factored in. Credit ratings of entities from which balances are due should, also reduces or increases the risk. So it would be probably inappropriate to have, bonds on your balance sheet that are rated lower, pooled with high-rated bonds. There are some factors around geographical locations that could affect credit risk. Kendall was alluding to, you might have tax receivables in different countries. It's also true that there are hyperinflationary, countries that are experiencing matters like that could impact the credit risk of an associated receivable or instrument. So that can also apply to investments. So this next one I was alluding to a little bit, the size of the receivable or customer. There could be some customers that are very reliable, and it might be, I've had a lot of clients who have, large governmental customers or balances that tend to pay slow, but have consistent history of always paying. So facts like that can be considered when determining these reserves. I'm not going to walk through all of these, but as you can see, there's a lot of different things that should be considered here. I do think this expected payment terms one is an important one. If you've got a customer that is paying, or just a counterparty that is paying every 60 days or has 60-day payment terms compared to a very lengthy payment term, that's going to drastically change the level of uncertainty and how much of a reserve should be factored in. So I've got a client that has, it's a not-for-profit, and it has certain loans that are payable by governmental institutions. Some of these loans don't actually have specific payment terms at all. It's really on a reimbursement basis as soon as funding from these governmental entities comes in. So they're, while the company still believes that they're collectible, they don't really know when, right? It could be 5 years from now, it could be next year. Those factors make it a lot different from a standard receivable from some sort of customer or party that is expected to be paid within 30 days, right? So it would be inappropriate to pool those two different kinds of contracts together. All right. So with these factors, we'll move on to the next slide. Okay, so we've got a test answer here before we move to the response. I'd like to see some Q&A responses. Not-for-profit university has two main outstanding balances under the scope. We've got receivable balances of student tuitions paid within 1 year. And we've got finance leases of high-tech equipment to start up research institutions to set up facilities. So, and I want to remind you, in the second scenario, this is a lending function for leases. This is not a lease under 842 as the lessee, which Kendall was highlighting the difference before. All right, so question one, should these assets be grouped together under similar risks? And question two, what risks can be considered to determine if this is possible? All right, so I would love to see some Q&A responses around this. Are these similar enough balances that we should group them together? Why or why not? Bonnie is saying no. All right. Any other thoughts? Are there any things here that might lead us to that no? I would tend to agree with Bonnie on this one. Shelley, could we move to the answer? So it depends. Oh, thank you, Bonnie. Yeah, it does seem like we have some different risks here, right? Individuals versus research institutions. The type of counterparty is a big factor in determining the risk, right? The length of the term for this balance is different. They could have very different credit risk ratings. A student might actually have better credit than a startup research institution. It might depend a lot on the student versus the institution in question here, but they could have very different risks associated with them. the size of the balance. There are some tech equipment loans that are probably smaller than student loans, but yeah, I think that would be a relevant consideration, right? Okay. So hopefully that example makes a little bit of sense, right? Now, you probably wouldn't want to have the same model for these two very different kinds of balances, just like you wouldn't want to have the same model for one of these student loan balances and for a debt security, right? That wouldn't exactly make sense either. Now, it might be that it's so immaterial, that the risk is so immaterial for some, that you don't even really need a model. But it's important once you've identified which of your assets are subject to ASC 326, that you then identify which of them represent separate pools. And then you can figure out, do we need a full-blown model, or is there such a small risk here that we can move on? All right, so with that, thank you for playing along, especially Bonnie. And we will move to measurement models, and I'll hand it over to Kendall.
All right, so we have identified what's in the scope and out of the scope of CECL. We've figured out our risk pools. Next step is to measure. So what the guidance says, right, and this is what one of the more challenging aspects of the standard is, there's not a prescribed method, right? So it doesn't say this is the method you have to use for this type of asset. There's a lot of judgment that goes into it. So anytime there's judgment involved, things are more complicated, and you have to figure out qualitative factors to determine which model makes the most sense. Now, what there are is examples in the guidance, so you can use those as implied ways to go about it, but there's, again, going to be a lot of judgment involved. The one thing to keep in mind, right, is you can have different models that go to different pools. So you don't have to choose one model and apply it to all the different pools, even within the same asset class, right? You have to determine which model makes the most sense based on that pool. As mentioned, judgment is required, and the model that you choose should be based on complexity and significance of the financial instrument. So if you have trade receivable and it's quick terms, you're collecting every 30 days, there's just not historical losses, obviously that's a lot easier, less complex. That there's one model associated with that, then long-term loan receivables with a bunch of different types of lendees, it gets more complicated. You're going to want a more complex model. So here are some of the examples of measurement methods. So the first two I want to highlight are the loss rate and the aging method, because these are probably two of the more common ones, especially with accounts receivable. So under loss rate, so this would be looking at your historical loss rates on each of the risk pools, and then adjusting that historical data based on current economic and forecasted economic factors. So you would look at, okay, historically we've lost X on these different pools. Well, is that historical data representative of what we're experiencing today, right? So things change over time. Maybe your collectability of some of these financial assets have gotten better, or it's deteriorated over time based on the economy, right? We know we're kind of going into a recession right now. The economy is getting tighter versus it was booming a number of years ago. There was COVID in there. So we need to kind of look at what we actually expect compared to historical versus point in time today, and then what we reasonably can forecast in the future. And we're going to get into what that means in a little bit, because that's, again, one of the more challenging aspects is the forward-looking aspect, because nobody has a crystal ball, right? The aging method is probably another one that's very common. So this would be looking at your age of receivables. So this isn't necessarily just losses of what you actually wrote off. It's also, well, what things are getting older, and historically what have your aged receivables been, what are they currently, and what do we think is ultimately going to become aged out of our current bucket, and then forecasting potential loss based on those risk profiles, because obviously older receivables are riskier than our current ones, but as Justin alluded to earlier, those current ones could get older over time. So we have to estimate that. The other three are a little bit more nuanced. So that's when you have more complex things that you're generally going to choose these ones. The probability of default. So that would be looking at your total exposed value when a loan defaults or an asset defaults, how much you would lose if there's a default, and then the probability. So, there's various factors that go into that. For example, if an asset's FDIC insured, or, if there's a collateral against it, or some other things like that that would limit your loss, you would want to factor those in. And then you would look at, okay, here's what our potential loss is. And then for each of those risk pools, what do we think the probability is that it will default and we'll lose that? So you're kind of weighting that probability. And as we got into the standard earlier, right, we said there's no consideration as for probable or not probable. So there's no longer that 50%. So even if you have like a 5% probability of default, you have to calculate that and estimate that in. As far as the weighted average remaining maturity, so what this does is it looks at historical charge-off rates. So it's going to be similar to kind of those historical loss rates in the first model. But what you're doing is you're applying that in a weighted average method over the term of the amortization period. So what that's factoring in is at the beginning of a loan, there's higher risk that you're going to lose some money or not collect all of it than the later on you get in the loan. So if it's a 10-year loan, at year one, there's a higher risk than there is later. So you're not saying, okay, it's just 1.5%. It's like, well, maybe it tiers down as you go. So we'll go through an example mechanically of how that works later, but just know it's kind of tiering down that risk as you get closer to maturity, because there's less risk later in that loan. And then also you would adjust that for any projected factors that are supportable if you think that historical loss rate should be tweaked. The last is the discounted cash flows. So that would be looking at discounted cash flows for the principal and interest collected over the term, discounting back. So that gets into projections of what you ultimately think you're going to collect on those assets. All right. Going into the next slide, we're going to cover the first model a little bit more detail, so historical loss. So a couple of things to keep in mind here, right? Looking at the period of time you go out, so you're going to make sure that lease goes out through the expected collected term. So generally, you're going to kind of start with the contractual term, and then you can adjust down depending on if you think there's going to be earlier payment. There are instances where you can actually extend it if there's extension options, and we'll go over kind of when that's appropriate. But generally, that contractual term is the starting point, and then you would adjust from there. In the first top left, right, it talks about COVID. So one thing to keep in mind is if there's these outliers of unusual, infrequent events, we want to kind of factor that in, because we don't always know, if another catastrophe is going to happen and needs to be considered. But, hopefully COVID was a once in a lifetime occurrence for us. And, some of the losses or things that happened during that period of time might not be representative of a go-forward basis. Justin and I were chatting about this as we were preparing the slide. And one of the things, another example is like Silicon Valley Bank, right? So what happened with them in First Republic, was it 2 years ago now? That was, as many could say, okay, yeah, that's not foreseeable. It's a one-time event. But it seems like now at this point, every 10 years or so, there's another bank that has some kind of issues that come up, and the government maybe backs them, or things happen. So maybe we do need to consider potential bank losses, right? Or other financial institutions that could potentially be recurring, even though it doesn't happen very frequently. If there's unreasonable, undue cost and effort to estimate some of these things, you can get away from some of it, but you can't just default to, I can't estimate it, because most things can be estimated, right? But just keep in mind, if there's not sufficient data accessible, then you might not have anything to include in there as far as historical, to adjust those historical rates. All right, next slide. So what, as far as the forward-looking things, so you're taking historical data and you're adjusting historical. So what is reasonable and supportable that you can adjust historical data or should adjust historical data? So these are things like macro and microeconomic factors, industry data. There's economic forecasts that come out. There's jobs reports. There are trade group reports on industry trends. So all these things need to be factored in, right? If you know a certain industry or a certain type of financial asset has been getting riskier as time goes on, maybe forward looking, you think it's going to continue to get riskier versus your historical trends, maybe it wasn't as risky, right? So you want to kind of look at trends, which direction you're going, and then figure out what's available to reasonably estimate going forward. So what is forecasted GDP going to look like? All those kind of things. Up in the future considerations tab, this first one, that one is key. So if there's any budgets or board forecasts or any business planning that the organization's doing, those things need to be factored in. So you want everything to be consistent, right? If you're projecting one thing internally for your budgeting, then you would also want to say, okay, well, does that affect our CECL estimates too? Because we're thinking certain things are going to happen with the business. Does that pose a different risk to our financial assets? What the last one here to cover, right, is the further out you get, the harder it is to project. So you go out as far as you can to reasonably forecast, but if you get to a point where you don't have reasonable and supportable forecasts, so say some of those forecasts, economic forecasts or whatnot, only go out 5 years. If you don't have enough data after 5 years, you can revert back to your historical data. You don't have to develop hypothetical things. So that's an allowable election here.
Yeah, I just want to chime in on the future considerations too. One of the things in here on the second point is industry changes and key metrics. So there are certain industries that are being impacted as technology changes, right? So there's certain so to the extent that an entity has endowments or debt securities that relate to industries that are struggling, for instance, broadcasting, right? A lot of people don't consume media and advertising through traditional broadcasting, and because of the way that technology is changing, that could factors like that might impact whether that's receivables due to businesses in those industries or it's investments related to them could really have an impact in the collectability or the realizability of certain assets. So there's a lot of changes related to technology, and I think that CECL is intended to make sure that financial statements are capturing some of those risks and identifying them as they're happening, not just waiting for bankruptcy to happen or something like that, right? So there's a lot of industries like that, and I think COVID certainly highlighted. There were certain industries that were impacted very differently by COVID, and whether that's investment in medical and healthcare, technology, or a lot of consumer products. There's a lot of different businesses that have been impacted, and to the extent that you've got assets that could be impacted by those industry-specific factors, the standard would expect that you're taking that into account. I know that's a little bit vague, but it's a factor that the standard setters are really expecting financial statement preparers to consider.
Yep. Good point. All right, next slide, please. So the period of measurement that you need to look out for these historical data adjustments. So you start with the contractual term, as I mentioned. It needs to at least go out that far, unless there are prepayment allowable within the financial asset. And then if so, you would need to look at kind of historical and anticipated prepayment behavior. So like, for example, right? We're in a higher interest rate environment right now. And if you have a loan that's at a higher interest rate, but there's prepayment options, maybe there's the assumption that at some point, if the Fed lowers the rate, that the borrowers will want to refinance and take that loan out at a lower interest rate, depending on their availability to do so. So that is one consideration. If we were in a low interest rate environment, like in several years ago, maybe that's less likely because the rates were only going to go up. So you have to kind of think about, one, is it allowable in the agreement, and then the likelihood that they would actually do so. The other thing to think about is going the other way, right? So if you extend beyond the contractual term, so you would only include extension options to the extent they're actually explicitly stated in the original or modified contract. And then they need to be, they can't be unconditionally cancelable within the control of the entity or lender. So basically the assumption is if you're holding a note receivable, you wouldn't cancel it, right? So you wouldn't extend it because you want your money back. But on the flip side, for the prepayment, the assumption is that they would if it's beneficial to them. So you have to kind of look at it from both sides, both the lender as well as the lendee. And I'm going to pass it off to Justin, who's going to talk a little bit more about other considerations for CECL, and getting into some of the allowances, and then we'll get into examples after that.
Great, thanks, Kendall. All right, let's talk about some other considerations. Okay, so there are some situations that we wanted to highlight where there might not be a huge impact of CECL. So, for instance, I know sometimes just simply for making things easy, companies would like to believe that that accounting standards don't impact their financial statements. So we did want to highlight that's possible, right? So you might have securities, maybe they are CDs, but they're U.S. Treasury securities. So maybe they really do have low risk, even though they're in the scope of CECL. That, some simple documentation calling that out is going to go a long way. There might be not-for-profits with receivables from U.S. government agencies where there's very little risk here, right? Now, I guess you would want to factor in, there are lately there are more tensions in politics around reworking of programs and administrative changes, but generally speaking, there's a presumption that U.S. government agencies will make good on their debts, right? Now, the timing of that could change, right? As there's like different budgeting applications and things like that. But those could be situations where we would say, yeah, there's pretty limited risk here. So even though it's within the scope of CECL, we've got good evidence to suggest that. So next here, we've got the expectation of non-payment regarding an asset measured on an amortized cost basis is 0. So that there can be, so it's really just a matter of documenting things and making sure that we've thought through it. So there might be no history of write-offs. There's no indication that might change. And maybe the entities or industries are well established and are experiencing, any turmoil. So I think that, again, it's just documenting why those facts lead to a low reserve. So in this last box in here, just needing solid evidence. So if a company is trying to make an argument that this is immaterial, documenting what these factors are, can be really helpful. If you're trying to persuade whether that's an auditor or a regulator, just laying out some of these factors can be very persuasive. But again, we're trying to lay out sort of what is the framework for evaluating how CECL affects the company. And then once you've done that, we can layer in some considerations as to why there might be limited risk here. And that's really all the FASB is asking us to do in this situation. So we could go ahead and move to the next slide. So one thing to consider, I know there's a lot of words on this slide, but subsequent events should be factored in to financial statement considerations, right? And sometimes after the year end, you might realize that certain balances that you thought were fully collectible aren't, right? So with all accounting estimates, you need to take into account all information available that was known or knowable at the time of recording it. And it might be that entities go out of business, or there's bankruptcy. There are factors in the overall economy that change, and estimates need to take that into account. So we've got here, default of a borrower. So these are some things. Now, you might not know these. Announcement of unemployment rates by the U.S. government. If you've got a lot of student loans and unemployment is shooting up, it might be appropriate to increase reserves, because that could be an important factor in whether those receivables will be received. There's also fair value of collateral updates. This could definitely affect loans that are collateralized, right? If there's a lot of loans out there, let's say, that relate to property that's in a disaster zone, and that there's some sort of catastrophic event that destroys property that was loan collateral, that could be problematic and would need to be factored into reserves, right? So just wanted to highlight that there are some situations here that need to be factored into reserves. And these are estimates. So there is inherent uncertainty around it all, but CECL does expect that you're going to use the information that's known or knowable to create estimates. Okay, so we just wanted to recap the measurement dates. So we got to follow the adopting CECL on day one of the fiscal year that's being applied. The transition adjustment is going to be the impact between what that adjustment, the new model under CECL would be versus the historical model. That adjustment would be reflected as an adjustment to net assets and the day one asset balances. And then for each reporting date subsequently, the changes in those reserves would go through earnings in the period of those financial statements. So any questions on that? For those who have adopted, who have followed the revenue recognition standard a few years ago, or even ASU 2016-01 with investments or leases. I think lately the FASB has been throwing a lot of these standards at us that cause a lot of implementation adjustments on day one that go through net assets. So maybe that doesn't seem too unfamiliar, but if anybody does have any questions, please don't be shy. Okay, let's move on. So we've got some illustrated examples of how to apply, and Kendall is going to take over after this polling question.
So this is a education not for profit example. So you got financing receivables. This is loans worth a total of about $1 million. So the fact pattern is an education institution provides funding to various R&D outlets that focus specifically on behavioral science to complement the educational curriculum of current and future degrees in psychology, ensuring students blah, 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 blah. And the R&D institutions are based throughout California. They have all existed for around 5 years. The funding is provided for a term of 3 years for all of them. And the annual payments with interest is at 2%. So here's the following data, right? So you got the origination dates, location, and you got the amortized cost balances. So the question, right, is, okay, are these within the scope of CECL? Yes, right? It's a financing receivable that's within the scope. The next step is the risk pools. So as far as the risk pools go, do we think that these need to be broken out separately, or can they be pooled together as one? And then after that, there would be what is the model that we're going to apply to it. So Shelly, if you can go to the next slide, we'll go through the results. So the answer on this one is pooling was not required, right? So the reason being, they're all in California, right? Same location, they're all similar size, they're all in, you know, a couple 100,000. It's not like one's 10 million and one's 100,000. They're similar age of entities, right? They've all been around for 5 years. They're all in the same industry. The interest rates are similar. So there's really not any qualitative factors that would indicate that they should be different. So what you would do is you would do a 3-year look back, right? So that kind of gets into that historical data. That makes sense because they've been around for 3 years and you have 3 years of data. That's sufficient to cover the contractual term that we mentioned earlier. So remember, you always want to look back at least that contractual term. And that calculates the expected loss. So they're looking at the amortized cost balance each year compared to the actual charge-offs, and that gets you to 1.15%. So the model that they chose to apply here was the weighted average, the WARM method. So the reason they determined that was reasonable is because there's steady payment streams, there's a relatively low interest rate, and their portfolio of similar loans. So they felt like that was appropriate to apply. So this kind of shows how that method is applied. So as I mentioned earlier, this is how they kind of taper that risk down depending on the closer you get to maturity. So you'll see the total balance at the beginning is $1 million, right? So they apply that 1.15% to that. But as payments are made, that 1.15% is calculated on a lower amortized cost basis, so it kind of tapers down. So what they do is they calculate the total. They then project what the total unadjusted historical write-off is compared to the original amortized cost. So it's 2.19%, and then they adjusted that down based on some qualitative factors. So what had happened here was new government funding was came out for R&D institutions, so that helped improve the financial outlook for these institutions. So they determined, okay, well, historically it's been X, but now we think on a go-forward basis it's going to get better, so we're going to adjust that downwards a little bit. All right, so that was the first example. The second example was a credit union. So in this example, it was $100,000 of debt securities, which are within the scope of CECL. And they were broken into 2 pools of government bonds and then corporate bonds. So the risk profile is going to be different between a government bond and a corporate bond, right? They're different types of entities that are holding those bonds. So they determined to break it out. And as far as the government bonds go, as we mentioned earlier, those likely are scoped out of the standard. So here's the criteria that I mentioned, right? So it's a narrow scope, and it has to be U.S. Treasury securities that are explicitly guaranteed by the sovereign U.S. government and can print its own currency. So generally most government bonds, the U.S. Treasury, are going to be meeting those criteria, but you just want to verify that those criteria are met. And then as long as that criteria is met, then you don't have to have an allowance. It would be 0. In the flip side with the corporate bonds, so they subdivided that pool into a little further based on credit rating, right? So they broke out the AAA versus the BA1, and or sorry, there's a range of both, but they looked at the range of credit ratings and they broke those out into 2 pools. And what they actually did was, okay, well, historically the losses have been 0 or very, very low, so we expect it to be 0. Well, you can't necessarily do that, right? Because we don't know on a go-forward basis if that's actually what's going to be happening. So what they used here was actual data from Moody's on the potential risk rating related to these types of bonds, and then they applied that percentage. So in the higher rated bonds, it was only a 5% historical, whereas the lower rate was 12%, and then they estimated that. Now, the thing to keep in mind is materiality. As you can see, these are pretty low dollar amounts. So, technically you have to estimate for all You can't just default of say, oh yeah, historically it's been low, but maybe the answer gets you to it's immaterial, and you don't really need to do much more of that. It could be below your posting scope or some kind of threshold that you can pass on, but you do need to at least kind of articulate that and document that, as Justin alluded to in the last section. All right. So illustrated examples how to apply CECL.
And Kendall, if I can
yeah.
interrupt you there, we did have one question that came up, and I know it is almost directly related to what you're about to go over right now. So wanted to make sure that we address it. And the question is just, how often should an organization be assessing the CECL? So the question that had a little bit more is, they're a school, they have tuition receivables. So should they be looking at the reserve at the beginning of the school year? Is it something that they would need to be looking at monthly? Or how often should they be revisiting that reserve for each year?
It's a great question. So I think it depends a lot on who the users of those financial statements are, right? Because some companies, they have annual financial statements on a GAAP basis, and they're not really used in operations too heavily. So maybe it's clunky to redo the whole reserve calculation only annually, and you forgot how it works and everything. And maybe that's okay. If you're at an institution where that data is being reported on a quarterly basis or even a monthly basis to other parties, and that estimate is really material, a monthly calculation might be way more appropriate, right? So the answer is always going to be it depends in this training if you haven't figured that out yet. But yeah, it really depends. I have friends who work in educational institutions, and there might be quarterly board reports. So that might be it might make a lot of sense to go through the mechanics of the update. And then to consider if that approach still makes sense, right? Because there could be factors that we become aware of that might mean we need a more nuanced model, or the makeup of the pools could change, and it might make it clear that we actually need a different pool all of a sudden because we have some different kinds of loans that it turns out are not the same. So hopefully that's helpful.
Yeah, and with any significant accounting estimate like this where the judgment's involved, I mean, at a minimum, you're going to want to do each reporting period, and any time the facts and circumstances significantly change, it indicate that you need to change your accounting estimate. So, COVID hits, the bank crisis, there's, the jobs report comes out and it's really bad and it affects your industry, right? Like anytime there's something major that, could indicate your estimate's not reasonable, then you need to factor that in.
And then just one other item to add there is, with the first year of implementation, you want to first assess it at the start of your fiscal year, what you think the new credit loss is going to be. And then, like Justin and Kendall both alluded to, really it depends on who the users of the financials are for where they're going to want to see that reassessment each year, but at least again at the annual reporting period.
Yeah, and that's a great point, Shannon, because you get into a little bit of this catch-22 of like, you have the benefit of a ton of hindsight, but you really have to kind of think back to the beginning of the year and what was known or knowable at that time, and then use that hindsight. But if those facts weren't known or knowable, or something major happened during the year, and the reason that matters is you need to determine, is it an adjustment to net assets at the beginning, or is it something that's going to hit your statement of activities during the year? All right.
Great.
Moving on. So kind of what to consider with write-offs and recoveries. So, okay, getting towards the later steps of this. So now you've built your estimate. Now what happens if you actually recover some of these, or if you physically write off that asset later? So for recoveries, right, it needs to generally be, situations like cash was received, there was proceeds from a liquidation, so maybe a customer went bankrupt and then you got proceeds, or if there's recoveries in their credit enhancement. So if something major happens with like a customer pool that enhances their credit risk and changes that estimate, then you can factor that in. And as far as the accounting for that, it would be debit cash, credit other income. So you would essentially, it's already reserved, and then you wouldn't adjust in this situation the CECL reserve. You would need to then factor that into the year end if it needs to be trued up with your total reserve when you're looking at the asset pools holistically. So this is just for an individual instrument or financial asset. With the write-offs, this is when you deem something that's physically not going to be collectible, and you're going to write it off, similar to what you did before under the old standard, right? You're going to write off the CECL allowance, you're going to write off the gross balance of the asset, and then you true up through gain or loss, depending on the difference in those two.
All right, so we've talked about the process of identifying everything that's subject to the standard, making those estimations and pooling and all that. And so we just wanted to highlight, what does this look like as you update your financial statements for this standard? So if we go to the next slide here, we've got some examples and some lists, just like everybody wants, right? All right, so one thing that should be an update to the standard is simply updating accounting policies, right? So that depending on your organization, the length of your accounting policies around reserves might be a really long, complicated policy. It might be simply what's in your financial statement footnotes, right? But you want to make sure that those policies are updated, and it's helpful to understand, what the main aspects of the policy is, and get that documented, right? It's good to have policies that stand so that if you have employee turnover or new factors, it's clear what that baseline was so that others can carry it forward, or that you can make updates when facts and circumstances change. So to the extent that we go through this and you identify that you've got a couple of different models for some different pools, it's helpful to really document why those models make sense and what those key assumptions are, so that it's understandable. So, next, presentation and disclosure, describing what the risk, what's subject to risk, what's in the scope for your financial statements is really important. Okay, so other aspects. So, as Kendall was walking us through the different potential methods, you want to make sure that we're documenting what those are, why they apply, the significant inputs. To the extent that you've got credit quality disclosure requirements, those might change a little bit when you implement CECL. So this is predominantly the case for entities that have a lot of loans. If you're in the disclosure checklist and you say yes to loans, the disclosure requirements are pretty significant. Okay, and then changes in expected credit losses. So the more material the changes, the more disclosures are going to be required about it to kind of highlight it and help. Really the objective is to just help users of the financial statements understand, what those changes relate to, how it affects, how it should affect their view of the company. Okay, so this is kind of just an illustration of what a roll forward looks like, right? We've got the beginning balance, and with the allowance, the current provision, the initial allowance recognized, and then you're going to have your write-offs and recoveries, which gets you to your ending balance. So I know that that's not really rocket science or anything, but this is just kind of trying to illustrate or bring together a couple of the components that we talked about. So I mean, this is going to apply a little bit differently depending on which financial instrument we're talking about. Whether we're talking about investments, you're likely not going to be having these write-offs and recoveries in the same way that you would if we're talking about trade receivables or potentially loans. Okay, if we could go to the next slide, please. Okay, so wanted to talk about the way this this affects disclosures in different kinds of financial instruments, right? And it might be that your type of organization only has one of these. So your financial statements might look a little bit different than, say, a lending institution, right? So if we've got amortized cost instruments, the allowance is going to be presented as a deduction to get you to the amortized cost basis, or I guess in some cases in addition. If we've got loans and receivables, the credit losses are presented as a credit loss expense in the statement of activities. And there are some elections you can make surrounding just interest, income, and expense. For held to maturity debt securities, the credit losses are going to be presented as a credit loss expense. For off-balance sheet credit exposures, and I haven't personally experienced these, but the guidance doesn't specifically say whether the credit loss expense must be presented in the same line as the credit loss expense for other assets in its scope. And for available for sale securities, the amortized cost and allowance for credit losses should be presented parenthetically, so called out separately. Okay, so hopefully that will be a good reference point if you're looking at this for your financial statement disclosures. And again, for some of these, it might be that you only have one account that has a material impact. So your disclosures should really focus on what are the most material aspects. It might be that you have some mutual funds and you've determined that they have a really low credit risk, and therefore there's not going to be a ton of disclosure related to it because it's really not going to change much, right? So that, I think that makes sense with all disclosures. It should follow the written, it should be presenting what's most material and impactful for investors or users of those financial statements, right? So scale the disclosures to appropriately based on the materiality and to the users. All right, next slide, please. Okay, so one of the best ways, well, maybe not the best way. One thing is Kendall mentioned that when you're looking at financial statements of a company that has adopted CECL, some of the terminology is going to change. For a lot of our more commercial for-profit entities, it's pretty clear that a company didn't know CECL existed if they're still talking about bad debt expense as opposed to credit loss. It might just be semantics, but there's going to be some basic terms that you will see that look a little bit differently in the financial statement disclosures, even if mechanically it's not working a lot differently. But for debt securities, we've got this allowance that is now being reported so we've got some parenthetical amortized cost versus allowance differences that we're showing in the second highlighted line. And then the allowance for loan loss, that's being called out separately as well. So hopefully that's helpful. We can go to the next slide, please. All right, so just want to talk about some key takeaways and open it up for questions afterwards. But so I guess kind of just big picture, right? It depends on what accounts you have, but CECL is very relevant to not-for-profit entities. And although we have been talking more about not-for-profit entities, a lot of these same considerations really apply to for-profits too, if you're working on it. So, good to know. CECL specifically is focused on credit risk issues, but those credit risks are affected by a lot of other risks that we talked about, right? So, CECL is focused on, we talked about this very early on, but CECL reserves should be recognized on day one of recognizing an instrument, and you're trying to anticipate what the lifetime of losses would be. So it's a little bit of an ambitious goal, right? That you're going to be able to predict accurately what what losses could be experienced through the life of a loan portfolio, right? But that's really what the objective of CECL is to do. In doing so, you've really got to break it into these homogeneous pools, right? To establish the different risks, find the best model for that pool, or simply to identify that the risk is so low you don't even need further consideration, right? Next point here, the historical loss is important because it will help you determine how risky each of your pools is. So as an auditor, one of the things I would do, I think when you're looking at a reserve under the old standard or the new standard, you look at historically what are the real losses experienced and compare that to the reserve. And if an entity's, if you go through this model and wind up with a giant reserve, but you still have no history of write-offs, I mean, that's going to tell you that it probably doesn't make a ton of sense, right? While CECL does generally increase the credit allowances for a lot of entities, historical losses still are important to use and to help inform those estimates. Now, that being said, it can't be based exclusively on that. There need to be taking this historical estimates and then considering what the future might hold. And in doing all this, we have to realize we should always be thinking about what is the impact of the financial statements as a whole. What are those disclosures going to look like? And are they going to capture the relevant information that's affecting the company's financial statements? So, so those are some of the big takeaways. And I believe we're going to be moving to questions after this.
Yeah, one of the first questions, and I see the polling question just came up as well, and this will be the last polling question for today. So one of the first questions that came up is whether or not for pledge receivables or promises to give, if those are being scoped out of this guidance, do those need to be renamed to say allowance for credit losses, or would those still be named, your uncollectible or allowance for bad debts on those individual line items?
Great question. Those, since there is relevant guidance for pledges receivable that's already out there, those should not change as a result of CECL. So if you do have accounts affected by CECL, those allowances and losses should be shown separately in most cases. Thanks for the question. I did want to give a quick shout out to one of our professionals on the call, Darren, who helped Kendall and me put together these slides, and he did a great job with that. So I wanted to thank him for that too. Thanks, Darren. Any other questions?
Those are the only questions. If there's anything else.
There's one in here. What are the GASB standard that is similar to CECL?
And in regards to the GASB standards, we would have to get back to you. The governmental auditing standards boards are different than FASB, so they are a different auditing standards board. So we would have to get back to you directly in regards to if GASB is following the same FASB type of a credit loss allowance. It is a separate standards for the financial statements for how they are issued and responded to.
There's another one in here. If we measure allowance for doubtful accounts on 90-day bucket for trade AR, do we continue with it plus the current AR assessment? So I guess the answer is it depends. So you need to pick a measurement methodology, right? So if the measurement methodology is based on aging, then you would need to, apply a percentage to the different aging buckets. So that would include the current, but you would need to kind of assess what historical aged amounts are and historical losses, and then apply something to that current bucket as well. So you may continue to apply the same percentage to 90 days, but it depends, right? You have to kind of look at it holistically.
Yeah, I would say the best models, even in the aging bucket, gets, one of the objectives is really to understand why is it that certain receivables wind up in that 90-day bucket to begin with. Whether that's because it's, customers, the way that you adopt CECL could be pretty dependent on what your credit check policies are like to begin with, right? There are certain, a lot of businesses only grant a certain amount of credit to begin with, right? So if you've got a robust process where you're only allowing customers, this is more of a commercial example, but if you're only allowing a certain purchasing power to entities based on your credit policies, it's going to be a lot easier to risk rate those customers in a CECL model. Same thing with loan applications and things like that, right? So depending on what data you have and is practicable to use for operating the business, you can really come up with some good ways to utilize that in developing a CECL model that makes sense. But a lot of entities might not really have this really robust credit policy, in which case you might have to be a little bit creative in thinking about, well, which are the types of, I've asked my clients in adopting this, like, how do you know when a customer is going to be a little bit of a pain? What are some of the factors that mean they're going to, be a late payer or try to negotiate some kind of settlement or charge off? What are the normal things that can make that happen? It might be that they're newer, or it might be there's certain product lines that entities tend to be less reliable in paying for. And those underlying factors might really change what your risk is in a more informed way than simply waiting for a customer to wind up in that 90-day bucket.
Yeah, that's a good point, Justin. And we see that here's an example of that as we see with consumer products selling to like big box retailers like Costco and Walmart. So you might have a large balance that's in over 90 days, but they always pay it, but they come back and say, oh, there wasn't a comma on the invoice, or they push back on something, and ultimately it's collectible. It doesn't necessarily mean it's the same risk profile as other customers that are over 90 days. So you have to kind of factor that into the risk pool, not just defaulting to the aging buckets.
Great. And with that, I'd like to thank Justin and Kendall, and then just highlight that our next nonprofit education series is on July 25th. Again, it will be 2 hours of CPE, and it will be on the nonprofit accounting and tax update. And just as a little bit of a preview, while there's been a lot of new guidance that nonprofits have had to adopt the last 3 years, we don't see any major changes going forward for the next fiscal year, for 2025 year ends. It seems to be a little bit more of a quiet time period for nonprofits. So unless anything changes, hopefully our nonprofit clients will be able to have a little bit of a break in regards to implementing another year of new guidance and changes to their financial statements. And so thank you, everybody. And you are able to register for this upcoming presentation on the resources tab as well.